Okay, a good afternoon and welcome to this innovation workshop with Charles Stanley on the penultimate day of our Genesis Digital 2020 conference. So I'm joined by Will Walker-Arnott, who is Senior Investment Manager at Charles Stanley. And the topic for today's discussion is Planning for Success, Insight into 2021 Public Markets. So I'll shortly hand to Will, but just before, just to remind you, if you do have any questions, please utilise the chat box for these. And after Will's presentation, we will have time for Q&A. If you can also remain muted throughout, that would be appreciated. And finally, just to highlight that the session is being recorded and will be available as part of the Genesis on-demand content between the 16th of December to the 7th of January. So with that, Will, I'm now hand to you. Thank you.
Alicia, thank you for that. And so, yeah, you can see I'm sharing my screen and that the title of this presentation is Planning for Success and Insights into 2021 Public Markets. And before we get on to 2021, and also we need to discuss 2020 because it's been a remarkable year. But before we get on to that, I just thought I'd quickly introduce Charles Stanley for those who haven't come across us. So Charles Stanley is one of the UK's leading wealth managers. We're currently looking after about 25 billion of assets in the UK, mainly looking after individuals, helping them invest their pensions, helping them invest ISAs. We also provide financial planning services. So if you're looking to prepare for retirement, or you're looking to prepare to hand assets down to the next generation, that's all things we can help you with. We've been around for nearly 2 centuries now, so we're an old, well-established company, certainly not a fly-by-night institution, and we've helped clients through some very tricky economic backdrops, which brings us nicely to what we are experiencing at the moment. And 2020 certainly has been one of the most interesting and dynamic markets I can remember. I've been working in the city for 16 years now, and the movement and volatility we see in the markets is like nothing I've witnessed before. And so if we just flick on to the first slide of this presentation, and first thing to get across is, I mean, I can't remember a time where we have effectively put the global economy into hibernation, which is what we've done because of this pandemic and because of this virus. So huge swathes of the global economy have just been shut down, and this is something we have not experienced before. The result of which is that if we take the UK as a case study, we have witnessed in 2020 one of the largest UK economic contractions in history. And you can see here that we are projecting that the UK economy is going to lose over 11% of its output. And that compares to other periods of stress, the aftermath of the Second World War, or even the great financial crisis of 2009. You can see we saw 4% lopped off GDP. So what we have seen over the last year is really a very dramatic cut in economic output, not only in the UK, but also on a global basis. And I suppose the best way to see the severe results of this economic contraction is just to look at UK dividends. If you look at the amount of dividends which are being paid by listed companies in the UK, you can see that it has fallen dramatically since 2019. So 2019 was a record year in terms of dividend payments. The blue line here is what you can expect to receive in regular dividend payments. Also, the yellow line added on top is special dividends. And as I said, 2019 was a record year, but 2020 is looking not very pretty. The UK has been particularly susceptible to a fall in dividends, mainly because of its weighting in the FTSE 100. It's heavily weighted to some of the more cyclically exposed companies. And by that, I mean things like the banks, I mean things like oil and gas, commercial property. And these are the areas which have been really, really hard hit by the virus. They are cyclically exposed companies. And when economic output falls, so does their profitability. We've even seen that the Bank of England demanded that UK banks stop paying dividends completely because they wanted them to preserve their balance sheets and protect their balance sheets so they could continue lending and supporting the wider economy. So we have seen a dramatic fall in dividends, over 50% fall in the UK alone, and it's going to take a long time to rebuild these dividend payments in the near term. The coronavirus is still with us, as a lot of you will be aware, and you can see there's been two distinct phases. This slide is just showing you what we like to look at, which is the level of hospitalization rates. The reason we focus on this, as you all be aware, is that if you're just looking at the number of cases out there, that's going to be affected by the rollout of testing. And so we focus on the hospitalization rate, and you can see here that we had the first wave in March, April, when we went into lockdown. We then saw in the Northern Hemisphere, cases died away during a warmer summer. And then it has picked up again quite dramatically over the winter months. And in the UK, as you know, we had a complete lockdown in November. We're beginning to open up the economy again now. But actually, as I speak to you, an alert has just come through on my phone saying that it looks like London is going to go back into tier 3 lockdown next week. And that is going to have a real impact on the service-led industries. So things like pubs, restaurants, hotels, they're going to have revenue once again cut off. And the question is, how long can they keep surviving these shutdowns? Can they continue? Can they get through to the perceived light at the end of the tunnel, which is in the spring of 2021? The other worrying trend, and this is a case which is fast moving, is the US, this black case here. And the US has generally been behind Europe in terms of this second wave, but we're beginning to see signs that the Thanksgiving celebrations they had towards the back end of November, huge amounts of internal travel around the US, the most amount of internal travel we've seen since March, has caused a real uptick in cases, both in terms of absolute cases and the number of hospitalizations. And that's something we've got to keep our eye on. The reason we're presenting this is because clearly it has an impact onto what's going to be happening in 2021. This, when we go into lockdown and when we have to put the economy into hibernation, this is going to cause long-term scarring effects onto the global economy. What do we mean by that? Well, we mean the obvious things like a rising unemployment rate. We're talking about companies having to actually go into bankruptcy. These cause long-term impacts to global economic growth prospects, and means that it takes a lot longer for us to ride out of this recession. So these are things we've got to keep our eye on. It looks like it's going to continue to be a long, hard, dark winter, and we've got to keep our eye on these rising rates and the level of economic scarring going on in the global economy. Now, despite all this doom and gloom I have presented so far, what has been amazing has been how resilient the equity markets have been during what has been a hugely difficult year. And so I've got 3 lines on this graph here. The green line here is the UK government gilt index. Now, these are meant to be safer than safe, that can survive any kind of economic conditions thrown at them. And as you can see, that line has been very steady during the year, and effectively they have maintained their value. And that's why you have UK gilts and UK bonds in portfolios, because they give an element of ballast and stability. Now, contrasting that, you can see the white line here, which is the S&P 500. This is the largest listed index in the US. You can see that it's been on a real roller coaster ride. Dramatic falls in February and March when the pandemic first reared its ugly head. But since then, one of the most dramatic rallies we've ever seen in the history of capital markets. And actually, the S&P 500 is now up 13% over the year to date. What has driven that? Well, you have to look at the underlying constituents of that indices. It's got big exposure to the large US technology companies. So companies like Microsoft, Alphabet, Apple, which have actually been beneficiaries of the pandemic as people have moved and transitioned and pivoted much more quickly to a more digital-led economy. They also have exposure to the healthcare and biotech arena, and that has also clearly been a beneficiary from what has been going on this year. So the S&P 500 remarkably is up 13% despite what has been going on. Now the orange line here is the FTSE 100, which by contrast, as you can see, has had a partial recovery and is by no means back to pre-pandemic levels. The reason for that is because, well, quite frankly, the FTSE 100 is now looking like a bit of a 20th century led index. As I alluded to earlier, big exposure to large commodity companies like oil and gas, big exposure to big financial houses like investment banks and big retail banks, got big exposure to commercial property. And these are severely disrupted industries. The pandemic has accelerated the move to digital industries. It's accelerated the green revolution as well. And this has meant that the FTSE 100 companies are the wrong side of this and continue to suffer. So it's interesting to see how UK markets have really lagged behind their US cousins. This chart a bit complicated, but it just shows you the S&P 500, again, the largest US indices which is out there, which we can track, just shows you how quick the recovery was. It's remarkable how quick the recovery was. So as you can see, we were down over 30% in March, and within 180 days, the S&P 500 had recovered all of its losses. If you compare that to what we experienced in the Great Financial Crisis, it took over 1,200 days for the S&P 500 to recover its losses. So it is remarkable how quickly that has happened. Sorry, I should correct myself there. This blue line here, 2007, this is referring to the recovery from the dot-com crash back in 2000, and that took, as you can see, a huge amount of time to recover back. So it does take a long time, and historically, but 2020 has compounded those expectations, and we have seen a remarkable rally there. Again, the S&P 500 has benefited from its exposure to technology companies in particular. So looking more particularly year to date, this shows you across the world how various indices have performed. And you can see here that it is the Asian economies which have outperformed even their US contemporaries. Asian indices are up 17% year to date. And that really is down to what we all know, that the Asian economies are well versed at responding to these types of pandemics. They've experienced it before, and they have dealt with the pandemic much more effectively, and really haven't seen these sort of second phase and third phase scenarios we've had in the Western world. That means that, you know, areas like South Korea, Taiwan, China, Hong Kong, Singapore, their economies have been recovering a lot more quickly, and there is less scarring there. So we are positive on Asia as an investment allocation for our clients, and we continue to be so purely because of their experience and their nous in dealing with these pandemics. Again, this column here reiterates that the UK is well behind, down 13% year to date, again for the reasons we were talking about earlier. So why have the equity markets been so strong and managed to rebound so quickly? Well, it all goes back to central banks. They have pumped huge amounts of stimulus into the economy, as we saw in the aftermath of the great financial crash in 2008. And they've done this in two ways. Number one, they've lowered interest rates. You can see here September across the world, anything which is in blue means that their interest rates are close to zero. And you can see in all the major economies, we've virtually got no interest rates. What this does is drives cash to areas where you can actually get a return. So money is being driven to the equity markets where people can actually get some sort of return on their money. People are reluctant to leave cash in the bank, and that has meant that we've seen this rebound in equity markets. The other thing which has been going on is that once again, central banks have been effectively printing money from nowhere and using that money to buy government gilts. And that has the effect of, once again, depressing interest rates and making sure that government gilts do not get expensive. And that's very important in a world where governments are having to borrow huge amounts of money to fund the fiscal stimulus they have provided the economies. You only have to think about the UK and the fact that the furlough scheme we've introduced in 2020 has resulted in net debt to GDP going above 100%. So our debt levels at the moment are over the entire output of the UK economy, which is particularly worrying. So it's important that central banks are keeping yields low and allowing the UK government to borrow at a cheap rate. November was another extraordinary month in the markets, and that really was down to, as you all know, the unbelievably positive vaccine trial data we got, starting with the Pfizer data. Then we got data from Moderna, and then finally we've also had positive data from Oxford University and AstraZeneca. And we are laymen in the financial markets when it comes to scientific matters, but one thing we were surprised about was the fact that you're getting 90% efficacy rates. A lot of us didn't see that coming. If you base it on what has happened in the past when we've been trying to deal with other pandemics, and that meant that November saw a huge rally in the UK equity markets across the globe as people suddenly realised that there was light at the end of the tunnel and we may be reopening the economies in 2021. So that was hugely positive. One of the significant trends we saw was actually the sort of stay-at-home stocks, which had been performing particularly strongly during the year to date up to November, things like Zoom or things like Amazon, they all actually sold off during November as people were suddenly drawn to buying the really cheap, clapped out, more cyclical type stocks. So we're talking about things like oil and gas, airlines, travel and leisure companies, and we saw a dramatic rise in those. And this is what we call a switch from growth investing. So growth stocks are like those technology companies, to value stocks, the ones that are looking very, very cheap. And this is one of the biggest moves we've seen from growth to value in history. And that was experienced on the 9th of November. So the vaccine trial data is undoubtedly very, very positive in the eyes of the market. Finally, we see the prospect that we could be opening up the economies in 2021. Most exciting to us at Charles Stanley, I suppose, was the AstraZeneca trial data, because that really is the people's vaccine in the sense that it's cheap and it's easy to just distribute. It's not such a logistical nightmare. So we will keep our eyes on that, and that has meant that UK markets and global markets have been much more positive in recent times. The other noise we've got in the background, of course, is Brexit, and that continues to dominate the news agenda in the UK. This chart here is just showing you how the pound has performed against the US dollar since we saw the sharp sell-off in 2016. And you can see that on the whole, there has been a gradual recovery in the pound against the US dollar over the last 4 years. Now, the market has baked in an expectation that some sort of deal will be done. If we don't get a deal done by the end of the year, then there is the scope for the pound to sell off once again. And that will actually benefit anyone who's invested internationally. So if you invested in big dollar earners or you invested over in the US, any fall in sterling will really benefit portfolios. We don't in our portfolios at present have much UK exposure, so any fall in sterling, if there was a no deal scenario, would benefit our portfolios directly. So looking at the winners from 2020, well, here are some of the stocks that we've been investing in at Charles Stanley and how they performed during the course of 2020. And the real winners, I suppose, can be divided into 2 or 3 areas. Number one is technology and the drive to digital services, which was in place prior to the pandemic has been accelerated hugely, and we've seen a real growth in technology and demand for technology services. Team 17 on the top here is actually a gaming company, so when people have been stuck at home, they seem to be playing a lot more video games, so there's been a big return there. And then Microsoft and Alphabet of course is the holding company for Google. You can see strong performance there. Life science and biotech clearly have been in demand, and people have been very interested in the city about some of this new mRNA technology, which I think has been used by Moderna and the Pfizer vaccine, and the implications that may have outside of dealing with COVID-19. So there's been a big demand in biotech as well. Croda is actually a UK chemicals company, but they are involved in producing the lipid which helps with the delivery of the Pfizer vaccine, and so they've seen a big growth there. And then finally, I alluded to earlier, Aberdeen Asia is a fund which invests in a number of Asian companies. You can see that that's been growing as well, mainly because they've dealt with the COVID situation much more effectively. And I should say that Asia still remains one of our preferred allocations for 2021. ESG is when we as investors look at environmental factors, social factors, and governance factors, making sure we're investing in good quality companies. And one thing we did at the beginning of 2020 was that we were sold prior to the pandemic becoming news. We had sold out of our oil and gas exposure, and we had reinvested back into renewable companies. And what this chart here shows you is the purple and orange lines are showing you the performance of BP and Royal Dutch Shell over the year to date. You can see they're down about 40% over the course of the year. Now, this is in direct contrast to some renewable funds we've been investing in. The first one is Gore Street, which is an energy storage company in the UK, and the second one is Trig, which is a wind turbine energy fund, and you can see that they perform much more resiliently over the year to date. And this is going to be a trend which we think will continue in 2021 as a lot of governments around the world talk about building back better. I think their focus and emphasis is really going to be on renewable projects, and we're glad that we took that move and pivoted away from oil and gas and carbon intensive energy producers early on and got into those renewable funds. So looking forward to 2021, the first thing I should say is that there is going to be a marked improvement in profitability in 2021. And the reason for that is, well, it can't really get much worse. 2020 was a dire year for profits. And so these grey bars here show you that we're expecting company profitability to increase throughout the world. But still, on the whole, it's going to be either below or marginally above where it was pre-pandemic, which is what this blue line is showing. So the good news is that profitability is increasing, but it's going to take a while to get back to pre-pandemic levels. If you're looking at the valuations around the world, well, stocks and shares are expensive, and that's really because with central banks lowering interest rates and increasing the amount of money being printed around the world, that means that valuations are higher than their average. So, I mean, our basic prediction for 2021 is that we are going to see positive growth in equity markets in 2021 on the basis that profitability is going to increase, but we think that it's going to be tempered slightly by the fact that we've had a huge rally in the last 6 months, particularly in November, and that will mean that we're not going to get those kind of dramatic moves again. It's going to be good, solid, steady growth in 2021, but nothing too dramatic. We think that you've got to continue to focus on the two twin revolutions which are carrying on in the world. So number one, we think you focus on digital companies and the drive to digital services. And number two, we think you still focus on green technology and renewables, because as governments try and build back better, they're going to focus in those areas. So what could go wrong in 2021? What are our chief concerns? Well, number one, that the rollout in vaccines does not go as well or as quickly as anticipated by the market, and the market the market at the moment is anticipating a very smooth rollout in vaccines, and for us to be up and running again in spring 2021. So any slowdown to that could knock valuations. The other thing is that if both governments and central banks don't continue to provide stimulus and actually roll back some of the stimulus they've been providing, that could also upset markets. But as I've said, the key emphasis for 2021 continues to focus on the digital and green revolutions. I think traditional retail, commercial property, oil and gas will remain at risk, and particularly if there's any more lockdowns around the world, those sectors are going to struggle. And finally, we still like healthcare, and we still like biotech and life science companies. I mean, traditionally they perform very, very well in recessions, which we are in at the moment. And also there's a lot of excitement around about the new technology which has been introduced over the last 6 months in dealing with this pandemic. So that's a quick whisk through what's been going on in 2020 and our outlook for 2021. At that point, I'll just pause and see if there's any questions out there.
Thank you very much, Will, for that, well, unsurprisingly highlighting the challenging year it has been, but ending it on somewhat more of a positive note, and for some of those predictions as well. I do have a few questions for you. So obviously you've highlighted COVID-19, Brexit. How about the other big news of the year, which was, of course, the change in US administration? How do you think that will affect markets in 2021?
Yeah, that's a good question. Something I didn't talk about in my presentation, so thanks for bringing that up. Yeah, the markets have taken the US election really, really well. So the main concern going into the US election was that we were going to have one of the so-called blue waves, which is where Joe Biden would have taken both houses in Congress. And under that scenario, he was going to hike taxes quite considerably. And so the market was very worried about corporation tax in the US in particular going up, and that having an effect, an adverse impact on corporate profitability. So the fact now that it looks like we're going to have a split Congress, with the Republicans keeping the Senate and the Democrats taking the House of Representatives, that means that the ability to actually raise taxes is going to be limited. The other thing, of course, is now hopefully we've got a more stable person in the White House. So foreign policy should be a little bit more stable, which the markets are very attracted to. And some of his appointments he's made already, Joe Biden, have been taken well. So he's appointed the ex-chairman of the Federal Reserve, Janet Yellen, to be the Treasury Secretary, and that's been seen very positively. Going back to some of the themes I was talking about, historically, Joe Biden is very keen on renewables and green technology, and that's something which will be a direct beneficiary of that. And just one final comment on the US election is, it always seems to be the case every 4 years that as you go into a US election, pharmaceuticals come under pressure because drug pricing comes up on the agenda. So we've been through that, and actually I think some of the major pharmaceutical companies are actually looking quite well valued at the moment. You look at things like Roche, you look at things like even Glaxo, a perennial disappointer, looks optically cheap at the moment. So there is the opportunity there to pick up some bargains.
Thanks, Will. I tried to hide some of my reactions there to the comments. That actually moves me on to my next question, which is the recent purchase AstraZeneca made of US-based company Alexion. Do you think that has anything actually to do with the change in the US administration? What's your take on that?
I think it's more about the fact that AstraZeneca is looking for a bolt-on acquisition which is highly cash generative. So they want to get back to the position where they can actually start growing their dividend year after year, which they haven't been able to do historically, mainly because they had this awful patent cliff, which they're finally getting through and building up their earnings profile. It's amazing to think it was only 6 years ago that AstraZeneca was actually the prey, and Pfizer was trying to take them out. And so this really is a bolt-on acquisition. It adds to exposure to sort of rare diseases where AstraZeneca doesn't have a presence at the moment. But what we like about it is it's going to enhance their margins, be very cash generative, and gives the opportunity, and this is what investors really like, for them to grow their dividend over the coming years, and that's why it'll be supported. The shares are currently off quite strongly in the market. Today's the first trading day since the announcement. The reason for that is because the currency they're using for the transaction is shares. So they're taking advantage of the recent high share price, and they're going to have to issue more shares to fund this acquisition. So the dilutive impact of that means that the share price is down today. But I think it just goes to reiterate that the one major success story of this pandemic is these smaller biotech life science companies. You only have to look at who's been winning on the vaccine race, and it's a small biotech company in Germany, or it's Moderna in the US. I know it's slightly larger, but it's not one of the large historic pharmaceutical companies, or it's the Oxford University. So it just shows you that these smaller led biotech life science companies are really driving innovation, and the big historically large pharmaceutical companies are having to buy in this expertise rather than doing the recent research and development themselves. So that's the theme which has been running for 2 or 3 years, and it's been continued by this transaction.
Yeah, it's great analysis there indeed. I've came across that term, from prey to predator. They're describing AstraZeneca now. It's made that move.
No, they have, and I think that was, that's another thing which is driving this acquisition. They don't want to ever be in that position where they could be taken out again. So you could see that as another reason for them doing this.
So mentioning obviously the vaccine, which of course is extremely positive news. On the other side of things, do you think we can expect to see a rise in taxes due to things such as that, coming out of the recent pandemic?
Yeah, so that's one thing we've got to keep our eye on, the sense that I talked about how much government spending has been going on in the last year, and everyone's fully aware of that. So effectively, they've been supporting the UK economy and around the globe. And that will have repercussions. So if we just focus on the UK, at the moment, it seems that the Chancellor doesn't want to announce tax rises yet because he doesn't want to peril the recovery, the economic recovery at this point. But I think that as we move into a point where we are seeing a stronger recovery in economic growth prospects, the second half of this year, there certainly is going to be tax rises on the cards. The things which are being speculated about are capital gains tax. That could be something which is going to come under the cosh. There's even talk of a general wealth tax. So people who have assets over £1 million may be taxed more broadly. But it's worth just mentioning that we do have specialists at Charles Stanley, financial planners, who can give advice on this once we know what the legislation is, and help you plan and protect and mitigate against these scenarios.
Great stuff. Thank you so much, Will. So I think that brings us to the end of our session, but that was extremely insightful. Thanks so much for your time. And then just to highlight that we do have further innovation workshops tomorrow. So we've got 10 a.m. Cambridge Pharma, 11:30 Telefonica, and then 1:30 Abcam. So with that, I will close. Oh, sorry, I think it was 1 p.m. I beg your pardon, Abcam. With that, I'll close our session and just say thanks once again. And then just to finally highlight that the on-demand version will be available via the conference app. So I wish you all a very good day. Thank you.